In this week's Stockscores Market Minutes, we're going to talk about 5 ways that you can be a better investor, a better trader in 2024. I'll analyze the markets, tell you where the stock, commodity, currency markets are likely to go, and then we'll look at the day trade of the week right at the end of the video. It's all coming up. Well, as 2023 comes to a close, let's think about some ways that you can do better in the market in 2024. The first thing that we're going to talk about is the importance of emphasizing abnormality. What do I mean by that? Well, we want to focus on stocks that are trading with abnormal volume and abnormal price action. And the reason is pretty simple. These are the stocks that are making the market-beating moves. We call them alpha stocks, and they're characterized by more trading volume than they would normally trade and price gains that you would not normally see. Now, there's some caveats to this, so what we want to focus on are the stocks that surprise the market with abnormal activity. Let's take a look at an example. Here you've got a stock that in the month of December had a great move, and you can see that it started with the abnormal price movement and abnormal volume. That volume was higher than any other day for a few months. The price action was abnormal, and it surprised the market. Prior to that, the stock was pretty boring, and then it came alive. And that is what predicted that that stock would make a big move higher. All right, number 2, be a good loser. This is counterintuitive, but the best traders in the world, the best investors in the world, don't take big losses. And so you have to go into trading and investing recognizing that you're going to be wrong some of the time. I know that's hard to stomach, but yes, we are all wrong some of the time in the market. And therefore, we must have a plan for what to do when we are wrong. We have to know the point where the market proves us wrong and limit our losses by taking the loss when the market tells us we're wrong. Now, how do we know when we're wrong? Well, the answer is to look to the chart and plan to sell if the stock falls through a floor before you've bought it. All right, so let's take a look at a chart, because it's always easier with a chart. Let's go back to this example. If we are buying here, or if we're buying here, then the floor before we enter is down here, or in the case of this buy, is down here. So I call that the last inflection point before the entry signal. And that's where I'm going to plan to lose. If the stock were to fall down through the floor, I get out. If it were to fall down through this floor, I get out. And that is my loss limit. And I actually use that loss limit point to determine my position size. You know, if I'm buying at $1.20 and my stop loss is at $1, if I buy 1,000 shares, my risk is $200. If I buy 5,000 shares, my risk is $1,000. Let the difference between your entry point and your stop loss point determine your position size. All right, let's get into the next one. Let the winners win. You hear this often. We have to be patient with our winners. They have to pay for our losers. Remember, we're not going to be right all of the time. So you have to let your winners win. As long as the stock you own is going up, hang on to it. Wait for the sell signal. Now that seems kind of obvious, but most people don't do that. They sell their winners early because they'll say, well, I don't want to get greedy. But really what they're doing is they're worried, they're scared that their winner is going to turn into a loser, or it's just going to start to go down again. Now, I like to use trend lines. If the stock is in an upward trend, stick with it. Let's look at an example. Here's the stock that did extremely well through the month of December. The entry point back here when it broke out from optimism through resistance. And then we had their upward trends. And it only broke the upward trend on Friday. This stock has gone from an entry point of around $11, $10.50, up to $31, and it gave the sell signal on Friday when it broke the upward trend line at around 27. So that is being patient with the winners. Doesn't mean you don't sell the winners. You always sell eventually, but you sell when there's a sell signal. All right, number 4, don't chase the crowd. Human beings are emotional. We tend to judge things based on what has happened recently. And so if a stock is going up, we're more likely to want to buy it because it's going up. We have this fear of missing out. Well, how do you avoid chasing the crowd? You don't buy stocks when they run away from their trend line. Let's go back to that same example. When the trend is linear, that means investors aren't emotional. So you can buy the breakout through resistance, or you can buy the pullback to the trend line when it bounces off of the trend line. But when price gets higher and higher above the trend line, do not be a buyer. It is too risky. You want to buy when they start to move, or you want to buy the pullbacks. Notice that the volume is highest when the stock is riskiest. And the reason is the crowd is chasing it. They're chasing it because they have emotion, the fear of missing out. Don't do that. It will blow up in your face eventually. All right, and our last one, don't listen to what people say. Watch instead what they do. I do not listen to the financial media. I don't read it. I don't watch TV. It's a waste of time because the financial media and people on it are there to talk about what has already happened. And they usually have a bias. The person that says, your neighbor says, you should buy XYZ mining company. Well, they probably own it. That's their bias. They want you to buy it as well. They want you to help them push the stock higher. And it's no different between the neighbor down the street versus the person on CNBC. They're all trying to get you to buy. Listen instead to what the market is telling you to do. That's why I look at charts. It tells me what people are doing with their money. I don't care what people say. You'll never meet a company that says, our stock is lousy, don't buy it. Companies are always telling you to buy their stock. The experts are always telling you to buy. But what really matters is what are people doing with their money. And when a stock starts trading abnormally, where it was before not doing anything abnormal, that tells you that something good is happening. When a stock runs parabolically upward away from the trend line, the message is that investors are irrational and emotional, and that bubble will soon burst. All right, let's get into this week's market analysis. I'm going to jump over to the Stockscores website. We're going to take a look at the S&P 500 chart. We've had great gains through the month of November and December. Once this downward trend line was broken, we resumed the long-term upward trend right as it bounced off of its trend line. So we talked about this. This is when I went bullish on the market, when we broke that trend line. Thought we'd get more of a stall there. We only stalled for about a week and then broke through, and now we're approaching the all-time highs. We don't have much upside until we hit resistance at those all-time highs. Notice that we are quite far above the trend line. We're rallying into resistance. So, although the market looks really good, the trend is intact, the buyers are in control, I'm concerned because we are coming into resistance and we're far above the trend line. We're a little overbought right now. So I'm bullish, but I'm cautious. I think there's a good chance we're going to see the market pull back. Now, how do we know when the market is pulling back? Well, go to a chart like this. This is a 30-day, 2-hour chart. Draw a trend line. If we start to break down through the trend line and build falling tops, then it's time to take some profits and be cautious. Let's take a look at the NASDAQ market, QQQ. Same sort of situation. Good upward momentum coming into resistance at the all-time highs. Very likely we pull back a little bit. That doesn't mean we're going to correct. It simply could mean that we go sideways for a little bit and then try to break out again. But it's quite likely that the upward momentum will slow in the next week or two. How about the small cap stocks in the US? IWM is the symbol. And you can see that they too have had a good month. They are hitting some resistance also from these peaks that have been hit a number of times. And so although I think it's likely to pull back, we still have much more upside until we hit the all-time highs. So I think the small cap market may be the better place to be as they play catch up to the large cap stocks. You know, the large cap tech stocks have led the market higher. They've really pulled those indexes higher, but most stocks haven't actually participated in the strength. If you look at the average stock, it hasn't gone up the way Microsoft or Apple or Amazon have gone up. These smaller stocks have lagged, and they're playing catch up. I think in the next couple of weeks, they may have a little rest, but I do think they have more upside than the large cap stocks. What about the Canadian market? T.XIU is the symbol. And like the small cap stocks in the US, they've got more upside till the next level of resistance. They've rallied into this level of resistance, and so we could see it pull back a little bit. But I do think there's still decent upside for the Canadian market, which has really lagged the US market. Let's move along to commodities. Gold has been strong the last few weeks. You can see that strength, but also notice it's been quite choppy, quite volatile. And so gold is generally in an upward trend, but it's volatile. And therefore, you want to be a little bit careful about trading it. I don't think it's real predictable. You have to pick your points where you're going to trade gold right now. All right, let's take a look at oil, which has not been the greatest place the last few months. It's starting to stabilize. You can see a little bit of an attempt at some gains the last little while as we come into this old trading range. And so I think the downside is probably limited for oil, maybe down to here at worst, but I don't see too many good reasons for upside yet. And so I think be cautious, but if we do start to get some strength in oil, a lot of these oil stocks are a little bit oversold and overlooked, and that may be a leading area if we can get some stability. All right, let's move along to the US dollar. Now the US dollar chart has this funny gap here, and I tried to understand if that actually happened because it's just such an odd move for the US dollar. And so I'm not real sure how to read this chart. I looked at a bunch of ETFs. They all did the same thing. And I just don't know that the US dollar actually fell that much. But right now it is in a bearish trend, so be careful. How about Bitcoin? GBTC is the chart that I like to use for that. And you can see that it was in a sort of a average upward trend, and now it's gone quite steep, which means investors are chasing it a little bit. I think it's risky, but there's no sign of weakness yet. Looking at the 1 month chart, we are seeing a little bit of a break of an upward trend line from a falling top. And so although the weekly chart looks okay, this tells me be a little bit careful going into January. We may see a little bit of profit taking on Bitcoin, and it's overdue because of the gains that have been made so far. Well, how about the bond market, TLT? That's been a reason why the market has done well the last 2 months, because the bond market has been going up, which means interest rates have been going down. But now the bond market coming into this old trading range, I think the upside for bonds is limited in the short term, which means the drop in interest rates is a little limited in the short term. It's not a bad thing, it's just time for it to take a rest. That's healthy, but expect that maybe that bond market's going to top out, maybe not next week, but in the next few weeks, it's likely to happen. All right, so my ratings then. On stocks, I'm short-term bullish, long-term neutral. And the reason I'm long-term neutral is those markets are all facing some long-term resistance. They haven't shown a break of the upward trend, but they're due for one. So let's watch for that. So be a little bit cautious with stocks. Gold neutral on both time frames. I like the trend, but I don't like the volatility. Oil short-term bearish, long-term neutral. US dollar bearish in both time frames. Bitcoin still bullish on both time frames, but a little bit scary the way it's run up so fast. I think it's due for some profit taking. And then bonds, short-term bullish, but also neutral in the long term as it comes into some resistance. All right, let's take a look at the day trade of the week, and it's actually more of a swing trade this week. This is a stock that made what we call an alpha echo signal when it broke out right here with an action candle. We highlight these things in the active live service on Stockscores. The buy signal on the 13-minute chart on December 27th at just a little better than $12. And as it is now, it's at $17. The market moving up quite quickly here. To me, the sell point was right there on the break of the upward trend line. And then you can buy it back on the pullback to the trend line. So when price runs away from trend, it's likely to come back. When it breaks the downward pullback off of the upward trend line, that's another buy point. So you had 2 buy signals on SSNT this week. Both worked fairly well and both fairly simple to find. Well, I hope that you've enjoyed this week's Market Minutes. I want to wish you all the best for the new year. 2024 hopefully will be a prosperous one for you, and I'll keep trying to help you. So make sure you're subscribed to the channel, and we'll give you these updates each and every week. As always, trade well.